Avoiding these 5 mistakes will make you a profitable crypto investor. Can you avoid these mistakes? Yes. Is it easy to avoid these mistakes? Well, probably not. Otherwise, everyone else would not be making these mistakes and they will be making money, which they are not. But you are here to educate yourself, so let's continue and learn about these mistakes so you can start avoiding them as soon as possible. If you made any of the mistakes that I will mention in this video, then make sure to comment down below. And at the end of the video, if the solutions that I provide are useful, then also make sure to massage that like button and subscribe to the channel for more knowledge like this. And with that, get your coffee and let's go. The first mistake that most investors and traders are doing is that they don't have a strategy. It sounds pretty obvious to you maybe, but most people don't even know what a strategy is. Actually, I have a video about that up here, so make sure to watch that later. But in simple words, a strategy is something that gives you a buy and a sell signal, so you can buy at a good time and you can exit at a good time. So you don't become a bag holder of any asset, even Bitcoin, because that can crash a lot and then your net worth will be diminished. And why would you want that? But where do you find a strategy that makes any sense, and how do you evaluate if the strategy makes sense for you particularly, right? So that's why people don't have a strategy, because it's hard, or a little bit of work at least, to get to a good strategy. So they fall back to emotions. So they buy when it feels good, which is at the top where everyone is bullish, and then they sell when it feels bad, which is mostly at the bottom, which is exactly why this happens to most retail investors. And some investors, because they don't know what a strategy is, they believe that HODL and DCA are actually strategies. I was talking about this in my previous videos as well, but in short, again, they're not strategies because they don't have a sell signal. And if they don't have a sell signal, they will not protect your portfolio from going down the drain when the trend turns around or when an asset goes to zero. The lack of a strategy often drives people to listen to influencers and social media for buy and sell signals. Actually, mostly for buy signals, because almost nobody is talking about selling, because every project that does anything in crypto wants you to buy and hold forever, right? Because that is great for their project, not so great for you. So you will find a lot of buy signals on the internet, but you will not find so many sell signals because people don't want you to get out of their project. And even if you find sell signals, you always find another guy on the internet who says that it's bullish and you should be buying or you should be holding. So which one do you trust, the bullish one or the bearish one? Hard to say, honestly. And this is exactly my point of needing a strategy. You need a strategy, otherwise you fall for all of these mistakes. And how to find a good strategy and how to evaluate them against each other? Well, simple. You watch this video where I explain exactly how to do that. The second mistake a lot of people make is that they do not understand the game. Trading and investing is a game, and it has rules and it has players. And if you don't know the rules and you don't know who are you playing against, then how would you expect to win? Okay, which rules do we have to take care of when trading and investing? Well, first of all, we have to understand that things come in cycles. For some reason, we have a 4-year cycle, and you can learn all about that. You can Google it. And the idea is that every 4 years, the US president gets elected, and the president wants to have a good mood to get re-elected, all right? So you have the 4-year cycle, and the US is dominating it because they have the world reserve currency, which is the US dollar. So that's one of the rules of the game, at least right now. The world order can change, but that's what it is today. Another part of the game is leverage. And leverage means that, let's say you have $1,000, but you want to buy for $5,000, so you have to borrow the remaining $4,000 from the exchange. So you leverage your $1,000 to invest with $5,000 in total. Now for that, you pay interest and all of that, but it means that if the price goes in the other direction than you have expected, then your portfolio will get liquidated. And that's what a lot of people are using to leverage the little money they have to make more money out of it. Now, why is that important to you, even if you don't use leverage at all? Well, it's important because there is a player called the market maker. And the market maker is a computer program with the goal to close the gap between the buyers and the sellers. And for the sake of keeping this video short, you have to keep in mind that the market maker gets paid by how many trades it executes for the exchange it operates on. If you now combine this knowledge with the leverage that we were talking about before, which is a rule of the game that leverage is possible and people use it, then now you know why the market makers are pushing the price up and down in zigzags sideways motion is because they want to liquidate as many people as possible that are leveraged, because then they execute most of the trades. Which is also why trading on a shorter time frame is higher risk, because you're also competing against this player called the market maker. If you're trading or investing on longer time frames, 1 week, a month, a year, then the market maker will have less and less, up to zero impact on your investment. You see, with this knowledge alone, you are better prepared than most people, and that's why it's so important to understand the rules and the players you're playing against. And I'm just scratching the surface right now because otherwise this video will be 1 hour or more. But if you want me to summarize all of these rules and the players, then let me know down below. The third mistake most traders and investors are making is that they do not know about position sizing, and they put too much money in very, very risky assets, and they put too little money in more stable or more blue chip assets like, for example, Bitcoin. And yeah, I get it. Most people want to make most of the money, so why not put everything onto Dogecoin or Shiba or whatever it is, Pepe, and then ride the wave up and become millionaires in like 1 week? Listen, sure, you can try that, but this is not a strategy. It is actually very, very risky. So if too much money is put into very risky assets, then those risky assets, if they go to zero or close to zero, then most of the portfolio will be wiped out, and that is not really smart. So that's a mistake, in my opinion, to put too much money into risky assets and too little money into blue chip assets. Now, the calculation that can be done here is quite simple. You can say, okay, what is the reward and what is the risk? Okay, it's high risk, so let's put less money into it because it has a 10x potential anyway. So even if I put $1,000, it will still make me 10K, which is great return, all right? So why would I risk a lot of my portfolio if the upside potential of these smaller coins is anyway very, very high? So some people even put $100 and they make 10K or 100K with that, but don't put too much money into such risky assets. Think about what is the upside potential of the coin and then put the dollar amount that multiplied by the upside potential will be exciting for you. And do not expect to make millions with just one coin. The whole portfolio is part of the game, right? The whole portfolio is in the game, and the whole portfolio has to work together to get you to your goal. So not just one coin. So if you do that, otherwise you will put so much money into that coin and then you might lose a lot of your portfolio. So a lot of people make that mistake. Position sizing is something that people think it's boring. It doesn't make any sense. But I'm telling you, it's a massive mistake. You have to think about how much of your portfolio you put into each single asset to balance your risk and reward ratio. A nice way to think about this is to put the coins that you're investing in 4 different categories. I have Bitcoin, its own category. How much of my portfolio do I want to have percentage-wise in Bitcoin? I define that before I go into the game. Then, how much percentage of my portfolio do I want to have in low-risk crypto assets? That can be Ethereum, Solana, Avalanche, Matic, things like that. Put a number before you go into the game. Then, how much percentage of my portfolio I want to put in higher risk assets? Again, define it before you go into the game. And then the 4th category is moon bags. How much of my portfolio I want to put there before I go into the game. It's not so complicated, and it will increase your chances of success dramatically if you prepare your portfolio in this way, that you don't go in there without a plan, because a lot of people go into the game unprepared, and then when they come back out, they come back empty-handed with their pants down because they put too much money into one coin or two, and then those coins crashed 95%, 98%, and now the portfolio is destroyed. So that doesn't make any sense. Make sure you're not one of those people. The next very common mistake is that people are selling winners too early and selling losers too late. An example of that is Bitcoin. In the last cycle, Bitcoin between 30 and 40,000 was quite overbought. A lot of people sold Bitcoin between 30 and $40,000 because they thought it will not go further up. But it did. It went up to 69,000. Now, if you sell winners too early, what happens is that you make less profit than you could have made, and that will not be awesome for your portfolio because you will have losers and then the balance will be off. So why sell a winner too early? How do you detect when to sell? Well, you need a strategy, which is what we discussed in the very beginning of this video. And the other mistake is that they don't sell losers early enough and they become bag holders on the way down. So when you have a losing asset in your portfolio, you have to get rid of it earlier than later, because otherwise it will drag the performance of your portfolio down. So make sure to have at least an indicator, something that is available for free, like the TradingView Super Trend indicator, which also I'm explaining here in this video, because at least it will tell you when the trend is turning around, and then you can get rid of that asset. If you don't have a better strategy, then use at least the Super Trend from TradingView. And the 5th mistake, and very common one, is that people don't understand that all of trading and investing is a game of probabilities. The idea is not to win every trade. The idea is to increase your chances to win in the game against the other players. So you need to be prepared so that your chances are as high as possible. Once I have understood that, my mindset has changed, and instead of taking unnecessary risk, I understand I need to first assess what is the risk, what is the reward, and then I can decide with how much money to get in, which strategy to use on this asset, and all these other things I was talking about. But understanding that this is a game of probabilities, actually understanding that it's a game at all, will change the way you perceive investing and trading, especially in crypto assets, but any assets actually, even stocks and other things, because it is just about being prepared as best as you can and having the highest chance of success. So when you look at the other players and you understand what mistakes they're doing and you can be better prepared than them, then of course that automatically increases your chances of success. Once I understood that, I actually decided that I do not want to trade on smaller time frames because I want to avoid market makers, right? Then I decided that I want to have a strategy that gives me a buy and a sell signal so that I know when to get in and when to get out, which protects my portfolio quite dramatically. Then I decided which assets I want to invest in. I put them into these 4 categories that I told you before. And then I decided, because I'm an engineer and I love that, I have decided to fully automate the process of buying and selling these assets. So I don't even have to click any button because it happens automatically whenever the time comes to buy and whenever the time comes to sell. So there are no emotions involved anymore in my process. And I teach this whole process that I have personally in my masterclass called autotrading.vip. I put all of my knowledge there. I'm also sharing my strategies that I'm using for my own money management there as well with all the members. If you are searching for education and solutions for all the things I mentioned in this video, then click the link down below, apply for access, and let's talk. But you don't need a course. You can watch this video where I'm showing you how to find and automate a strategy from TradingView fully for free. It's a step-by-step tutorial on how to automate a strategy to buy and sell on your exchange. You can thank me later, and I see you over there. Cheers.